Hey everyone, thank you for tuning in. In today's video, I'm going to be doing a detailed breakdown of some recent trading opportunities using the 15-minute and 4-hour trading strategy that I recently shared on this channel. I'll pop it up on the screen so you guys know exactly what I'm talking about. If you haven't already seen that video, definitely go watch it. And if you have already, this video is going to be very interesting for you. All right, everyone. So we're taking a look at EURUSD to start things off. This is one of the first trades that I took this week on the 15-minute time frame, of course, using the 4-hour time frame as the bias. So we're going to start out by looking at the 4-hour time frame so I can briefly explain that. Now, if I quickly use the Fibonacci tool and drag it from the swing low down here all the way up to the swing high right up here, you'll notice that price is still trading within premium prices, okay? So anything that is above the 50% of the current range is premium. Anything that's below the 50% of the current range is discount. We want to be, of course, selling in premium and buying in discount. The 75% is my ideal entry point for either buying or selling. And in this scenario, with the Fibonacci tool drawn, you can see that price is nowhere near my 4-hour Fibonacci retracement level that I would look for. We can use that information to go down to the lower time frame, in this instance, the 15-minute. That's my favorite. And what we can do is look for selling opportunities. So that's exactly what I did here. And it was very, very straightforward. As you can see, we're starting to see bearish price action, bearish structure forming. And when I was available at the charts, of course, there's other things to the left that we could consider. But when I was available looking at the charts, this is the opportunity that I saw in front of myself. So very clean, very textbook opportunity here. We have a swing high right here, a swing low right here. The Fibonacci tool was drawn between those 2 points, identifying this bearish range. And what does my 75% retracement level land on? Well, it lands really nicely on this imbalance, which you can see highlighted by this gray box here, courtesy of the Currency Pros indicator. It just shows us all of that stuff. Order blocks, imbalances, structure, Fibonacci, all kinds of stuff. I have the order blocks turned off right now, but of course there is an order block right here. So that's nice as well. So I simply set a limit order right here based on these parameters, and it was right at the 75%. So it got tagged into the trade right there, moved quickly into profit, and then it came back up to my entry. I did not move this to break even. So typically with my swing trades, after about 2 hour in profit, I'll move it to break even. However, with these shorter duration 15-minute day trades, I don't do anything with them for the most part. In certain instances, if it's more of a risky trade, then I'll manage it aggressively. But for the most part, I'll just leave it and let it do its thing. So this unfortunately came back to the entry point and into a little bit of drawdown. It actually pierced above the previous high there, just pushing deeper into this bearish price leg. It looked like it actually tapped into the wick of that order block very precisely, which is interesting. But I don't trade based on order blocks anymore. It's a nice confluence to have, but I enter based on Fibonacci just to simplify the process. After price violated this previous high that I initially entered from, it pushed to the downside once more. So let me continue playing it forward. And that was the move that eventually hit the full take profit level. So that was a really nice trade to start things off. And other than the minor drawdown here, it was a really textbook trade in terms of the 15-minute style. And one thing I want to clarify before we go into more examples is that this strategy that I'm using right now on the 15-minute time frame, it's literally the exact same strategy that I use on the 4-hour time frame, and it's the exact same strategy that I use on the daily time frame. So depending on market conditions, we can take advantage of the fluidity of this strategy. It has a very dynamic nature. It can be applied to literally any combination of time frames or even a single time frame on its own, if that's what you prefer. So I like to use the strategy based on how the market is behaving. So for the past few months, really, there hasn't been many swing trading opportunities for me. So I just have to be adaptive to that and work with what the market is giving me. I've been noticing a lot of really high probability, high quality setups on the 15-minute time frame. Of course, using the 4-hour time frame as the anchor time frame where I formed my bias. So as long as I'm trading in line with that 4-hour time frame, like I am here, then I'm a happy camper. So again, I'm selling on the 15-minute because I'm anticipating price to trade much lower until it reaches discount pricing, right? Which is all the way down here or anywhere in this region, basically. It doesn't have to be exactly the 75%. And then at that point, if price is to get there, then I would not be selling on the lower time frame. I would be looking for buying opportunities on the lower time frame to capitalize on bullish momentum. I hope you guys enjoyed that example. Let's move on to the next one. So next up, we have EURNDZ. Now, unfortunately, I didn't get involved in the trades that I'm about to go over. Some of our community members did, and I also talked about this in some of our weekly ongoing content within the Currency Pros community. However, because I was getting involved with EURUSD, I did not feel comfortable also getting involved with EURNZD because there's too much correlation there, and that would be me overexposing myself, which is very irresponsible and unprofessional. So I stayed away from these personally, but I want to go over them anyways because it's nice to see the analysis play out, and it's a good example of how the strategy works. So we're starting things off on the daily time frame, and that was because I previously identified this range from this low all the way up to this extreme high here. Now, of course, you could map this to any one of these highs, but because there was no significant retracement and it just kept kind of crawling higher to the upside, I decided to just map the Fibonacci tool to the extreme high and the extreme low here. So that's the daily range that I was looking at. And I was simply waiting for price to retrace back into these discounted levels, which it of course did. And so once it got to those discounted levels, I was then monitoring the lower time frame, which we'll go over in a sec, to look for potential long opportunities to get involved. Now that we've gone over the daily time frame, let's take a look at the 4-hour time frame. Not too much to see here. The entries would have been placed on the 15-minute time frame. On the 4-hour, there just wasn't enough structural change just yet. So let's go down to the 15-minute time frame and we'll take a look at these opportunities step by step. So there was actually 2 opportunities here. Again, I didn't get involved in either of these, full transparency. Let's take a look at the reasoning behind them though. Let me just zoom out until I can find my Fibonacci tool, which is way back here because it's on the daily time frame, right? So that was the 75% level that I was discussing on the daily time frame. Now, if we scroll to the right, you can see that price was reacting to that general area, not that precise area, but that general area of discount. So all you need to do in that instance is wait for bullish structure to start forming. And that's of course exactly what we can see here. So this first opportunity right around here, that certainly would have been a bit riskier than the second one that we'll go over in a minute. The first one is a little more risky because there wasn't significant breaks of structure just yet. Of course, you could say that all of these were breaks of structure, which technically speaking, yes, they were. This move broke through all of them. But in the grand scheme of things, it's hard to identify these as their own swing points. And it would be a lot easier to identify the entire range as a swing, right? So that would mean we'd want to see the overall high be broken, which it was somewhere around here, right? So again, even though this was a valid opportunity, it would have been a little bit riskier. Now the setup though is still the same as every other setup. We have a swing low here, swing high here, Fibonacci tool was dragged. We have imbalance and an order block within this region here. Price retraced back into the 75%. Pretty much sniped the 75%. There would have been almost no drawdown there, and then it went straight to take profit within an hour. It's a pretty substantial opportunity there. But like I said, it would have been the riskier of the 2. So let's focus on the second one, which is, it was more of my focus at the time, but like I said, I was already getting involved with EURUSD, so I didn't want to overexpose myself. Now again, we see the exact same setup here. It's very repeatable. It's literally copy and paste. So swing low, swing high. I know some people would get confused with this, but the thing is it didn't break through this structure right here. So it's just insignificant in my eyes. So I focus on the overall range and try not to focus on the minute details within the range. So swing low to swing high, Fibonacci tool was dragged at 75%. As you can see, price tapped into the 75% and almost immediately went into profit, retraced close to entry again, and then hit the where the take profit would have been set. 2 very straightforward trading opportunities here on EURNZD. And again, it's just using the higher time frame bias as an anchor. So in this case, it wasn't the 4-hour, it was the daily time frame. And that doesn't really matter as long as it's a higher time frame, something substantial enough. So I wouldn't really consider, anchoring it to a 1-hour time frame, a very high time frame. That's just kind of insignificant to me. In my opinion, a higher time frame is the 4-hour or the daily or the weekly or the monthly. Those are high time frames, right? So if you're anchoring your intraday bias to those higher time frames, it creates really highly probable, powerful trading opportunities because you have such a strong perspective of where the market may be trading to next. So I hope these 2 opportunities provided some value for you all. Now let's jump into the next one. All right, now next up we have NZDUSD. So this one's going to be very similar to EURUSD, so I'm actually going to go through it fairly quickly. On the 4-hour time frame, just like EURUSD, we have a swing low and a swing high. Now in this case, since we had this wick pierce above the previous highs, I would drag the fib tool like that. I always focus on the extremes, so this would be the safest option for me. Now again, full transparency, I did not get involved with this one either because I was involved in EURUSD. So this is just an example of how it works across multiple assets. and you can really pick and choose whichever one resonates with you. So this is the 4-hour bias. Clearly, I would be looking for price to retrace all the way down to discount pricing around the 75% region for me personally. For you, it could be anything. It could be the 62, the 67. The 75 is just my personal preference. It allows me to get a consistent 3-to-1 risk to reward ratio every single time. So it's very repeatable. But anyways, this is the bias on the 4-hour time frame. So like I said, I would be looking for price to retrace to the downside, which means if I'm on a lower time frame, I can be looking for selling opportunities, right? I can be a seller. So what do we see on the 15-minute time frame? Well, we can see a news-driven, very unsustainable move right here. So that's already a warning sign that price is likely going to keep retracing to the downside and violate everything that just happened here. Typically, news candles are very unsustainable. It's typically just to liquidate everybody in the market and get people excited and get their hopes up. So that's already a warning sign. So this is the setup that presented itself on the 15-minute time frame. It's pretty straightforward in terms of the setup itself. Of course, everything you see to the left here is a bit distracting, but again, you need to focus on the bigger picture. So we already painted the bigger picture of the 4-hour bias and how we're anticipating selling opportunities until we get into discounted pricing, because we have to realize we're at extreme premium prices in this range up here. So that's a big warning sign that price is going to start trading to the downside. So on the 15-minute time frame, you have to remain stoic and not get overwhelmed by moves like this, because again, it was news driven, so it really doesn't mean much. So focusing on the actual setup itself, we can just see bearish structure, very clear, very distinctive. We have a break of structure right here with full candle body closure. So that's a big deal. And then if we draw the fib tool from the swing high to the swing low, which is already done here, initially it would have been drawn to this swing low, but then price kept trickling down to the downside. So you just adapt it and move it along to this low, because again, we go for the extremes, right? We're not focused on the minute details. We just go from extreme to extreme. And it's a lot simpler and a lot safer that way. So with that fib tool being drawn, we can see that the 75% retracement, which is my personal preference, lands in and around these two imbalances. So that's a good sign. There's also an order block right up here. But again, I don't really trade based on order blocks anymore. I used to a long time ago, but I decided to simplify my entry process by having a Fibonacci retracement number that gives me the same risk to reward every single time. It's just a simpler way to do things for me. But anyways, the order could have been set right here at the 75% entry, and let's play it forward and see how it played out. As you can see, it tapped into that 75 level absolutely beautifully, non-existent drawdown there, and pretty much went straight to the take profit without any real pullbacks of any significance. So another great trading opportunity. And if we just keep playing price forward, you'll see that the bias is to the downside, because that 4-hour range price needs to enter the discounted regions within that range. There was actually many opportunities to get involved in short trades within these moves here. And again, it's just keeping the higher time frame bias in mind. So as long as you anchor your day trading to a higher time frame bias, it becomes a really, really powerful strategy. And that's what I've been showing you guys here on YouTube for free. And keep in mind, I didn't create any of these concepts, and that's why I feel comfortable sharing it on YouTube, because my value personally lies elsewhere. Like within the Currency Pros community, we do a lot of ongoing weekly content. We have a full content schedule, and we're constantly guiding and supporting our members towards success. And we offer many other proprietary things as well. So if anybody claims to have created these concepts, that's a huge red flag. So there's really no reason to gatekeep this information. And that's why I'm comfortable sharing it on YouTube. The people who created these styles of trading, they're either dead or very, very old right now. Even the people that you think of who claim to have created these concepts, like whoever you're thinking of in your head right now, they learned it from somebody else as well. And I've said this in the past, but I just want to clarify it. I hope this was another good example for you all. NZDUSD, again, very similar to EURUSD. And there's one more that I want to share with you all today, and I kind of saved the best for last. So let's get into it. XAU USD, gold. So this is an asset that I have very, very rarely traded in the past, for the reason being, I am mostly a swing trader. And this asset has not performed very well for me in swing trading ever. So I kind of just removed it from my watch list for a very long time, because I just kind of deemed it not very valid for my style of trading. However, given the fact that I'm very fluid between day trading and swing trading in terms of my strategy, it's an extremely dynamic strategy that can be applied to any combination of timeframes or any single time frame. I decided to give it another chance recently, and my goodness, it's been performing very, very well. from a day trading perspective. So the reason I'm including it in this video is because I think there's some very powerful lessons to be learned here. Again, keeping the higher time frame bias in mind, we're currently on the 4-hour time frame. I'm able to capitalize on day trading opportunities on the 15-minute time frame. And the cool thing about gold is that it moves pretty quickly and there's a lot of volume. So you can see trade ideas come to fruition fairly quickly, which is definitely a good thing. One of the reasons why I've never enjoyed swing trading this pair is because, like I just discussed in previous examples, I like to target the 75% retracement level for my entries. On the 4-hour time frame and on the daily time frame, you'll notice with gold that this happens a lot of the time. You'll get retracements, like very clean retracements within a trend, and gold tends to trend very nicely. But the thing is, it never, or almost never, gets back to my 75% entry. It usually does like anywhere from a 30 to 50% retracement before taking off again. And that's why you'll see so many breakout traders trade gold. However, it's also favorable for my style of trading, but just on a lower time frame, I'm starting to realize. I can still use the 4-hour time frame to have an overall bias of trend direction, of course. And using that bias, just like in previous examples, I can either trade counter trend or pro trend on the 15-minute time frame. So that's exactly what I've done this week. And I've had multiple profitable positions on gold, basically capitalizing on this entire down move right here. So we're going to go into that on the 15-minute time frame. So we're now on the 15-minute time frame. I only have 2 position tools and 2 Fibonacci ranges printed here, but I also entered a couple scale-in positions somewhere in the middle here, which I'll go over in a sec. Let's start out by discussing the first position, the very first one, which is of course, I guess, the riskier one, because me choosing to enter this trade here, it's very risky because I'm going against this entire bullish trend prior to that move occurring. So I'm really asking a lot from the market here. The initial trade idea here was just beautiful, right? We have a break of structure to the downside, very distinctively, very impulsive move, and then a clear retracement back to the upside, and it perfectly sniped the 75% entry level. Now I placed these parameters here for visualization purposes, but I didn't actually enter right from there. Unfortunately, I missed that entry. So let me hide it for a second. I was just simply not available at that time. I didn't see that opportunity. After this reaction occurred, I got to my charts and saw this opportunity somewhere around this area here. Because I was so confident in the bias of this trade idea and the way it reacted to my 75% ideal entry point and how it rejected from it, when price began retracing a little bit, I simply manually executed a position right on this wick. It was as simple as that. So yes, my risk to reward was a little bit compromised in this specific trade, but that's okay. It's the trade idea that's important. I just wanted to get involved with it. And literally as soon as I entered on that wick, it shot straight down to the take profit that I had set. I'll put a screenshot on the chart as well so you guys know that I actually did enter from that wick. And then after that hard take profit was taken, price began retracing again, and I entered a couple more positions right around here. So again, it's all based on the same idea here, but this one in particular was executed a bit differently than my other ones because there was no limit orders. Whenever I'm setting limit orders, it's very clean, it's very predictable. It's a 1 to 3 risk reward every single time because I'm entering from the 75%. But if I'm manually executing, there can certainly be some discrepancies. But overall, I've been doing this for over 6 years. I know what I'm doing in terms of entry and stop loss placement and things like that. I had entered these 2 trades here upon this retracement. It definitely went a little higher than I expected. I was expecting it to be still within the range here. I didn't expect it to pierce through that high. I felt that it would be within that high, but luckily my stop loss was around here. I remained in the trade, and I am so glad I put my stop loss where I did, because you can see what happened afterwards. Price absolutely melted like ice cream on a hot summer day. Just kept going, and is still going right now. This is not replay mode anymore. Price is still dropping. So pretty crazy move. You know, part of me, of course, wishes I didn't have a hard take profit set, but you know, that's the responsible way to trade, to have hard limits set for both stop loss and take profit. So I like to get in, get out. You can always look at a trade and say, oh, I wish I did this, I wish I did that. But at the end of the day, we need to have a system that we go by, because that's how we gain an edge over the market, and that's how our numbers play out over time. If we're just doing things sporadically and randomly, then there will be no consistency to our trading. So it's very important to set those those limits ahead of time. Within this whole down move right here, there wasn't much opportunity to get involved again. I guess you could have gotten involved here. I was actually waiting at this point in time for price to go a little bit higher, somewhere around this level here, and I was looking to enter another manual scale in position. However, it didn't get back up there, and I wasn't comfortable with entering this low in the range here. But it seems as though it reacted to this imbalance, or fair value gap as many like to call it, between these two candlestick wicks. There's a gap there. So price mitigated almost the exact 50% of that range, of that fair value gap, and then just absolutely melted. So really cool to see the accuracy of that. And that leads me to today's trading opportunity. So at the time of recording, today is Thursday, May 23rd, I believe. And in today's New York session, I capitalized on another short trade here. I'm going to tie this all back to the 4-hour bias in just a second, but let's go over the setup first. So as you can see, price was moving down very rapidly, and it was giving retracements, but not significant retracements, right? Very short 20 to 30% retracements. However, this range occurred. We had a clear break of structure to the downside, broke through this low, obviously, came back down again, and then retraced all the way back up to my ideal entry point. I was confident with this one because the candles were starting to get smaller and smaller. This corrective momentum was occurring, so it wasn't very impulsive, it wasn't aggressive, so I felt comfortable with that. And so as soon as price got to my 75% entry area, I entered a manual execution. I didn't have a limit order set here. I was available at my charts looking at them, so I just manually executed the trade. Pushed into profit a little bit, quite a bit actually, and then retraced again, and I decided to scale in to another position. The initial position that I had set, because I set it manually, I actually reduced my risk, so it was half the risk I would normally go for. So as soon as price began retracing a little bit, I entered another position to make it the full risk that I'm usually entering with. And I was comfortable doing that because of the initial rejection that price made and how far into profit it went. I was comfortable with the overall directional bias here. So I entered another trade. It still retraced a little bit higher after I entered the second trade, but then I think it was at like 10 o'clock or something. 9:45-ish Eastern Standard Time, of course, New York time. It melted again and hit the take profit very rapidly. So that was another great trading opportunity. And honestly, I'm anticipating this to happen again, maybe not right away, but I would anticipate another short opportunity coming into play very soon. And the reason for that is going back to the 4-hour time frame. Let's take a look at the overall bias here. You'll start to understand why I have such a short bias on the 15-minute time frame. Because on the 4-hour time frame, let me use the replay tool and take it back to here. So initially, I was like, okay, this is the current range that price is trading within. I know that on the higher time frame, price usually doesn't respect these extreme retracement levels like I have set at the 75%. If we get into that region, I would certainly not feel comfortable entering any trades because that's too deep on the 4-hour range for me to be comfortable with, on gold specifically, keep in mind. And so as soon as that happened on the 4-hour time frame, I was like, okay, gold never does this. Gold doesn't really get back to that retracement point. So that means if it is at my retracement point, it's likely going to violate the whole range, and this is going to be a reversal to the downside. So that means this bullish trend that we've been experiencing is likely going to fail right now. So it would be wise to just stay out of the market. That whole point in time where I was saying there was no real entry opportunities and price was just melting like ice cream on a hot summer day, that was during this move when it was in extreme discounted prices. So again, gold, from my experience, it seems to typically retrace about 30 to 50%. So seeing a 70 to 80% retracement is very abnormal. So that tells me that the trend is likely to fail. This low is likely to get taken out. So you'll see that my next short position on the 15-minute time frame, which we just went over, it was after price broke through this structure very significantly, right? So now replay mode is off. You can see the current price. So obviously we broke through this low very significantly, right? Let me just delete the fib tool there. In the near future, I'm sure there will be a retracement back to the upside. But overall, the 4-hour bias now is short to the downside. There could be a retracement back into premium prices of this range because this is our new range, right? And then we could see another drop to the downside. So there's a lot of ways to take advantage of pretty much every asset class using this strategy. It's fine to just stick to one time frame for trading if it's a higher time frame, right? For a long period of time, I was taking only 4-hour trades. I've taken a lot of daily time frame trades as well, like executed on the daily time frame. And I still do that. I still mix in day trading and swing trading. I have many different accounts. I have different portfolios for different purposes. However, when it comes to day trading or intra-session trading, whatever you want to call it, it's very, very difficult and somewhat unwise to stick to one single time frame. Like if I were only doing the 15-minute time frame, I would most likely have a very low win rate, probably like 20 to 30% win rate. If I was profitable somehow, I would basically just be scraping by, because I would never know what the bigger picture is. I would never understand the macro perspective. I would only be focusing on the micro, on the 15-minute structure. And that's just kind of a recipe for disaster. If you're going to day trade, just pair your execution time frame, your lower time frame execution time frame, with a higher time frame bias, such as the 4-hour or the daily. If you do that, your win rate should be around 50 to 60%, maybe higher, maybe a little bit lower. But if you have a strong risk reward ratio of 1-to-2 or 1-to-3, then the numbers don't lie. You're going to be an extremely profitable trader over time. So if none of this made sense to you guys, I would strongly recommend watching the day trading strategy video that I posted on my YouTube channel for free a little while ago. That'll explain the strategy more in depth as well. It's very straightforward though. I feel like I've done a decent job explaining it in this video as well. So hopefully I'm getting my message across. These are the last examples that I wanted to discuss today. So I really hope you all enjoyed this video, and I put quite a bit into this. So if you did enjoy it, please hit the like button and comment down below. Hopefully something positive. Hopefully I provided enough value for you to leave a positive comment. And if you haven't already, please subscribe to my channel. The subscriber count is getting up there, and I'm very, very grateful for each and every one of you. So I really would appreciate it if you'd subscribe. You know, let's continue to grow this trading family here. So thank you all for watching. Thank you so much. And I'll talk to you all in the next one.